So the biggest takeaway, so Seth kept saying, Mo, you got to read this book. You got to read this book. So I read the book. The biggest takeaway that I took from it
I hope you bought your own copy.
I did buy my own copy.
And for everyone you know. Good.
I did buy my own copy. But it is lonely out there. I mean, for me, I have Paul. Yeah. Paul basically has me, and there's nobody else. So we're fortunate and we have each other. But when it comes to that lonely world of value investing, there's so many other people that think like us. And that's kind of what it went to. And I always tell people, you need to be very patient and brutally honest with yourself if you want to be able to do this. Can you actually do this in a time like we're in right now? Can you find those stocks that are wildly undervalued and be comfortable buying them as they're going down when everything hits the fan, like you said?
So to me, that's the harder part. Like, it's funny you mentioned about Bitcoin and Tesla, and you talk about missing those. Like, I have zero FOMO, zero fear of missing out. Like, literally, I see Bitcoin and Tesla, and I go, man, whatever. Like, I literally don't even go like, man, what am I missing? But the hardest part of investing is when it's falling considerably and you say, I have a thesis that Alibaba stock is worth $450 a share today. It's selling for $140 and it keeps going lower. What am I missing? That to me is the harder part.
Yeah.
Hey, William.
See, I rarely buy an individual stock, but I did recently buy Alibaba when it fell. And so I only own about 3 stocks. And so when that fell, I was like, well, this seems really obvious, right? I mean, it gives you an opportunity to buy really cheap into the Chinese economy over the long run. I'm going to be happy to own this for 10 years. I immediately lose 25% of my money.
Of course. Join the club.
And that was after it had already plunged. And I'm not that pained by it, to be honest.
Good.
And I'm not saying this as an ad for Alibaba, because if there's one thing it's that I don't know enough about this, because I'm not really good at
because you're brutally
businesses.
honest.
But there are a lot of people that I know who are really, really smart, who I really respect, who do own it. And so I'm sort of, to some degree, I'm cloning what some of the smartest investors I know have done. But what makes it so difficult is that at these extreme periods, you don't actually know if you're right. You never really know if you're right. And so I think one of the things that you have to do is sort of hedge against your own incompetence and ignorance and inability to foretell the future. So you want to diversify a bit. So if Alibaba halves again, it's not going to mean that I can't send my daughter to college for the last 2 years of her college.
Right.
I'm going to be okay. And so some of it is just setting yourself up so that you have the humility to say, if I'm wrong, I'm still going to be okay. And there's a guy called Jeffrey Gundlach, who's known as the king of bonds, who manages something like $150 billion, some enormous amount of money. Very clever, very kind of swaggering, multi-billionaire guy who I interviewed for the book. And he said to me, this is not a guy with a small ego, right? I mean, he's very smart. And he knows how smart he is. And he said, I'm wrong a third of the time. And John Templeton said to me as well, he said, I've made 500,000 investment decisions in the course of a lifetime. And he said, about a third of my decisions are, as he put it, the opposite of wisdom, which is a euphemism saying, I was dead wrong, right? So Templeton, greatest international stock picker of the 20th century, Rhodes Scholar, came top of his class at Yale, brilliant guy, wrong a third of the time. Jeff Gundlach, king of bonds, brilliant guy, wrong a third of the time.
Right.
And so what Gundlach said to me, so you know that I'm going to be wrong more than a third of the time. So what Gundlach said to me is, you need to ask yourself, if I'm wrong, what's the consequence? And that's a really profoundly important question. So if I'm wrong about Alibaba, there's not really a dire consequence. I'm going to be okay because I'm not living beyond my means. I don't have a lot of debt. I'm sufficiently diversified that I'll be okay. So one of the things that I'm doing is, look, I know a lot of really great investors, right? So I own probably 3 funds, a couple of hedge funds and a mutual fund. But even there, I'm like, what if someone I think is great turned out to be a con man? Or what if someone, because one of my flaws is I'm too trusting and I like people and I'm empathetic. And so I get into the minds of someone and I'm like, I really like this person. I want to have them in my life. And so I'm vulnerable to the fact that I'm trusting. It's part of knowing your own vulnerability, your own peculiar nature and flaws as an investor. And so I'm always thinking of this thing that Templeton told me 20 something years ago, where he said, you shouldn't be arrogant enough to believe that you've figured out the one country, the one asset class, the one fund manager.
100%.
And so he said to me, he said that for an average investor, for a regular investor, you should probably own about 5 funds, and they should each be exposed to a different area of the market. And so every time I'm getting carried away and I think I should make an enormous bet on Alibaba, like a great investor recently said to me that he was considering being all in. He's like, if I had more cash, I would be all in on Alibaba. And this is, but it's a guy who's already a multi-billionaire. It's like, what does all in mean? It's like he's got so many other investments. So you're always having to say, what's the consequence if I'm wrong? Live within my means. Be patient, diversify a bit, keep your expenses down, your trading expenses, your taxes, take advantage of tax advantage vehicles. All of these things that are kind of boring and obvious and mundane. But if you keep doing it and then you avoid really stupid stuff like trading in and out of the market and pretending that you can predict which way the market's going to go, which if Howard Marks and Joe Greenblatt and Charlie Munger and Warren Buffett can't do it, I sure as hell can't. Mm-hmm. If you get those basic things right and you just stay in the market and you avoid stupid stuff and you buy things cheap and you hang on to them, you're going to do great anyway. So what I try to console myself with is like, if I miss Tesla and I miss Bitcoin, I'm still going to be fine because I'm going to keep owning a bunch of stuff that's relatively cheap for a long time, and in the end, it'll be okay.
Awesome.
It's funny when you talk about. It seems like you belong on our show because we have these same conversations about Tesla a ton, about cryptocurrencies. You were talking about learning the laws of the game, and then or like say you're a pilot and your plane's going down, open up the manual. I was gonna say have you been on YouTube? Because it seems like there's a lot of new manuals coming out that are defining the laws of investing that seem to be just again, head scratchers. Is this new information sharing, YouTube and just constant news sources? How is this affecting? We think it's somewhat dangerous. A lot of new investors are coming in and they're getting exposed to just some absurdities out there. What is your take on today's market and where it's going?
Yeah, one of the things first I would say I have no idea where the market's going, and I don't think anyone does. And I think one of the most important things to start realizing is that the greatest investors don't make predictions about where the market's going. They say, I can't do that. I don't believe in economists' predictions about what inflation is going to do and where growth is going to be. And, maybe if you're Ray Dalio or you're a great hedge fund manager like Jim Simons or something, you can make some useful predictions about the future. But I sure as hell can't. And so one of the things that you need to do when you're filtering stuff out is you just say, well, all of these morons who are making market predictions and are pretending that they're valid, they don't know shit. So I'm ignoring them for a start. And so that's a very helpful filter. Then all of these people who are promising extremely high returns with low risk, you're like, well, I'm filtering that out because they don't know shit either. Sorry to be rude, but I mean,
that's how we talk too. Keep it going. Keep going.
Thank you for saying this.
This is not an easy game, right? And so, I mean, so people who pretend that it's easy, or who pretend that they know the future, or who pretend that they've cracked the code and nobody else, and they're better than everyone else. Those people tend to be snake oil salesmen, and so you want to have a little bit of humility to say, I don't know what the future holds, so I'm going to set myself up for an uncertain future so that I'll prosper whatever happens. I'll be okay. I'll survive. I'll survive the dips when COVID comes along, or when 2008, 2009 comes along and the financial market melts down, or when the Twin Towers were blown up and the market was literally closed for days. And so I'm interested in the people whose principles have survived the test of time.
Absolutely.
And yeah, the world changes, and sometimes there's a paradigm shift. But it goes back to Templeton saying the most dangerous words in investing at this time is different. It's like, Nah, usually it's not different. Usually,
Never
I mean,
different.
there's a
Same game,
beautiful
different
image.
players.
Yeah, there's a beautiful image from Howard Marks, who I write about at length in a chapter called Everything Changes, which is about the fact that everything is impermanent, everything is changing, yet somehow we have to make decisions about the future. And he says that he doesn't make any market predictions, and he doesn't have an in-house economist at the firm managing 140, 150 billion dollars. And he says, I'm not trying to predict the future, I'm trying to predict the present. He's just looking at the present and he's saying, well, what are the conditions now? Are people taking too much risk? What's their attitude to risk? How is risk priced? Are you able to get things cheap, or is there a lot of optimism priced into these assets already? And so he says that it's kind of like if you're driving in icy conditions. If the conditions are really icy and it's snowing and it's, the road is treacherous, you drive more carefully. And then when everyone else is panicked, but actually things are really cheap, you can gun the engine a bit because there's real opportunity, because there's no optimism priced into assets, so they're cheap. So what he says is that it's really helpful to view the world as operating kind of like a pendulum. It's not going in a straight trajectory. It's like swinging back and forth between fear and greed, optimism and pessimism. And so you need to look at the world and say, well, where are we right now? Are we closer to the point of maximum pessimism, or are we closer to the point of maximum optimism? And I don't know what the future holds, but it's pretty clear to me. I can see, having started as a financial journalist around 1998, 1999, when we were in a dot-com bubble, I can see the same sort of behavior, where just people are throwing caution to the wind. I remember back then, you could invest in an IPO and it would go up 600% in a day, and you'd be like, God, how come I'm not getting into this? And then I write about one of these companies in my book, this thing called Giga Media, where I say, it was taken public by Deutsche Bank and Goldman Sachs, right? I mean, Goldman is pretty elite bank, right? They were just selling any old crap that anyone would be prepared to buy. Like, as I said in the book, feed the ducks while the ducks are quacking. And that was what Wall Street was doing. And so Giga Media, this company that had like this distant dream of making money one day, suddenly goes public, surges on the first day, and has a $4 billion market value for a company that's worth pretty much nothing. And then a few weeks later, the bubble bursts and it loses 97% of its value. And so you just have to be aware that Wall Street is full of people who are just trying to sell you stuff because it serves their financial interests. And so you have to step back and think for yourself and think, well, are we getting carried away? Is this a game I understand? Do I understand the rules of the game? Am I educating myself? Am I, to use a phrase of Buffett's, am I a continuous learning machine? You need to be a continuous learning machine. So it's not enough for me to say, well, I should avoid Bitcoin because it's a bubble. It's like, no, I'm ignorant about cryptocurrencies. So I need to learn more about them so I can understand if this truly is a paradigm shift. And if something, and I think it is, I think culturally and economically, it's such a profound thing. It reminds me of when the internet was, becoming something we couldn't ignore in the late 90s. And even technophobes like me were suddenly like, actually, this is a pretty significant shift. And so I'm not denying the importance of cryptocurrencies, but doesn't mean that it's cheap or that it's a good game for me to play. And so, yeah, you're just having to think for yourself and always ask yourself, what are the incentives of the person selling me stuff? And, people delude themselves. So you can have very decent human beings who are really lovely, who are nice to their dog and nice to their mother. But they still, when money is involved, they'll sell you terrible stuff because they've convinced themselves that actually, no. Then years later, they're like, oh yeah, we all knew that it was a dot-com bubble. It's like, well, so how come you were selling us all this shit at the time? So people's capacity to fool themselves is pretty impressive. So you just have to educate yourself, think for yourself. And part of what's difficult, it sounds like a really weird analogy, but when I was a teenager, I started to become obsessed with jazz. And I would buy albums. In those days, you go to the record store and you buy a cassette or a vinyl. And I would buy stuff and I'd be like, oh, so Dizzy Gillespie, okay, he's really good. And then I'd be like, oh, he played with Charlie Parker, and so I'd buy that. And then I'd be like, oh, and Charlie Parker played with this guy, so I'd buy that. And so it took like years to kind of orient myself and to figure out, oh, actually, I really like this type of jazz, not this type of jazz. So I suddenly discovered I really love 1940s bebop or something like that, or Duke Ellington. My son's middle name is Ellington because I love Duke Ellington. And investing, it takes a long time to orient yourself and figure out, so who should I actually listen to? Because there are all of these people selling moronic stuff on YouTube or through their funds or whatever. And some of them, they're getting so rich and they're such good salesmen that it's very disorienting. And so, I mean, well, part of what I'm doing in my book is I'm trying to say, listen to these people. I'm not saying I'm so smart, but I'm saying, listen to Howard Marks, who's really smart. Listen to Charlie Munger, who's really smart. Listen to Ed Thorpe, who's really smart. Educate yourself about these principles. Go back and read Jack Bogle's books. Look at companies like Vanguard that are actually set up to be honorable and to help you. And then you look at things like Goldman Sachs that are really glamorous and Deutsche Bank stuff that were taking things like Giga Media public. And you're like, these guys are really rich and they're really beautifully dressed and they're really smart, but they're not necessarily looking out for my best interests. And that's been disillusioning for me because I would always have had kind of awe for, brilliant people going to Goldman Sachs. And it's like, no, it's just another, they're just, I don't know. I was going to use a very rude analogy.
Yeah,
my friend Guy Spear, I helped him write a book called The Educational Value Investor many years ago. And Guy, I remember, we would have these sort of these candid discussions together while we were working. And he said, yeah, you look at Goldman, they just like, they use better lubricant on the rusty pole before they bugger you with this, and it's like, I don't know.
What pole are we
better
discussing?
At making themselves look
it's gold.
pious.
Yes.
So but they're still serving their best interests, and this is human nature, right? We're all, we all influenced by our own incentives, and so as a regular investor, you have to say, is this person's is the fund aligned with my interests? Like look at the fee structure of a mutual fund or a hedge fund and say, is it structured in a fair way? So you look at a Vanguard index fund and you're like, wait, they're charging me 0.14% or something like that a year. That's structured in a way that's honorable. You look at Berkshire Hathaway and you see they charge no annual management fee. And Buffett and Munger are paid something like $100,000 a year to run a company that's worth hundreds of billions of dollars. So they're basically incentivized to make money with you, not off you. And you look at that and you're like, oh, okay, they're not out to screw me. And so look at the incentives, look at the fee structures, look at how people are paid, not at what they say, but how actually they're paid and how they behave. And
don't look what they say, you look what they do.
Exactly. So if you go to Omaha for the Berkshire Hathaway annual meeting, Munger will say, we totally failed you by not buying Google. And he'll say, oh, and we also failed you by not buying Walmart. That was obvious. That was right in our circle of competence, and we screwed that up too. And so you look at people like that and you think, wait, they're telling me stuff that's true and that's not in their own best interest. Those are people I'd like to, be in bed with over the next, 10, 20, 30 years. The culture like that, where they try to tell you the truth and they structure their incentives so they're fair. So every time I see people say Berkshire Hathaway's losing its way and Buffett's lost his way, and
It's so funny.
I'm sort of
It's
like,
comical.
well, yeah, maybe, but I really like the way it's structured so that they're not overcharging us and they're treating you fairly and they don't bury their mistakes from vision. They actually, Munger often says, I like people who admit their horses' asses and rub their nose in their mistakes. And so they're not making out that they know everything. They're literally telling you when they screwed up, because that means they'll screw up less next time. Right. And so you do need to educate yourself. This is not one of those areas where you can fly blind and you can assume that people are looking out for your best interest, because even the most decent people when it comes to money, I think, tend to operate based on their incentives, not based on your interests.